Hello, I'm Bernard Hickey from Interest.co.nz and welcome to a special economic weather report from here at the Reserve Bank in Wellington, where the Reserve Bank has just released the half-yearly financial stability report. The Reserve Bank looks at the health of New Zealand's financial system, its banks, how the rest of the world's economic and financial situation is going to affect those banks, and then ultimately the New Zealand economy. And the Reserve Bank has said that the global economic downturn and the risks of a crisis in Europe have made New Zealand's financial system slightly less safe. However, the Reserve Bank thinks that banks here are stronger now than they were before the Lehman crisis of 2008. Interestingly, the Reserve Bank has decided to delay a measure to increase what it calls the core funding ratio. And this will make it slightly easier for banks to fund their own lending. Remember, about 2 or 3 years ago, the Reserve Bank introduced the core funding ratio. Now, this was designed to reduce the reliance of banks on hot international money. Now, this is the money that has to roll over every 90 days. And New Zealand has been quite vulnerable in the past to a freeze on these international markets. We saw a freeze after the Lehman Brothers crisis, and the Reserve Bank had to step in and help out the banks roll over some of those short-term debts. And when it did that, it realised it needed to force the banks to find more of their funds from longer term and more mature and more stable funding sources. So that means shifting funding from those hot markets to longer term bonds, often offshore, and also to term deposits here in New Zealand. And it's set in place a series of steps to increase that core funding ratio. And today the Reserve Bank has decided to extend or delay the next step in that increase in the core funding ratio. Currently it's at around about 70-75%, and it was due to increase to 75% from the middle of next year, middle of 2012. Now the Reserve Bank has said, we'll wait until the beginning of 2013 before we increase that core funding ratio to 75%. What does that mean? Well, unlikely to affect interest rates anytime soon. However, it does give the banks a bit more flexibility if the financial crisis in Europe really does go pear-shaped. And obviously we've heard over the last couple of days with the meltdown in the Italian bond markets and concerns about how that would spread to the European banking system and the European economy, that our banks, who do raise still some of their funds, about a third of GDP has to be rolled over every 90 days or so, they have reduced their reliance on those international markets, but they still need them. And the Reserve Bank is saying, we're going to force you to pull back from those markets relatively soon, and we're going to give you a bit of flexibility to do that. Elsewhere, the Reserve Bank has commented that the New Zealand dollar is potentially going to fall quite sharply if we see more volatility on these international markets. It's also commented on the level of farm debt and household debt, warned again that we're quite vulnerable to a downturn because of this high debt, and it's also commented that the government needs to continue to tighten its budget to help New Zealand reduce its net foreign debt. Well, there we have it, our special economic weather report brought to you in association with the Bank of New Zealand from here at the Reserve Bank of New Zealand on the occasion of the Reserve Bank's half-yearly financial stability report. I'm Bernard Hickey for Interest.co.nz.